Okay, let's unpack this. You sent over a really fascinating stack of sources detailing this massive conflict brewing in the solar sector right now. We couldn't wait to dive into the data. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks.
And today, we're zeroing in on SolarEdge Technologies. That's ticker SEDG.
Mm-hmm.
All the research we're using was captured this morning, November 10th. 2025.
Right.
And our mission really is to figure out if this recent spike in the stock price is, a genuine turnaround based on results, or if it's more of a speculative, a sugar rush that might just fade away.
Okay, good plan. But before we zoom right into SEDG, let's quickly set the macro tone for today because, on the surface, it feels like a total risk-on day, doesn't it? The S&P's up nearly 1%.
Yeah, NASDAQ is flying even higher.
Exactly. NASDAQ's up 1.5%. Looks great.
But, that green screen, it can be a bit deceiving. There's a counter-narrative sort of bubbling up here. Our research flagged a warning from a White House economic advisor.
Oh, really? What's that?
They're saying the ongoing government shutdown could seriously damage the economy, like potentially push Q4 GDP into negative territory.
Wow. Okay.
Now, you've got the markets cheering, seemingly, but this huge yellow warning light flashing out of Washington, it's quite the contrast.
That macro uncertainty is definitely a huge headwind then. Okay, but let's zoom in on SolarEdge itself because those Q3 results you highlighted, they seem to be flying right in the face of all that fear, don't they?
They really do.
Looking at the research stack, the fundamentals look, pretty stellar. Q3 revenue hit $340 million.
Yeah, that's a massive jump, 45% year over year, and a solid beat against expectations.
And they narrowed their adjusted loss too, right? Down to just 31 cents.
Exactly. Operationally, it looks quite strong. And interestingly, U.S. sales now make up 60% of their business.
Okay, so good numbers. But here's where it gets, fascinatingly disconnected based on what you said.
Huh.
Wall Street seems deeply skeptical.
That's the paradox, yeah. The company's performing, but the market, or at least the analysts, aren't truly buying the valuation story yet.
How skeptical are we talking?
Well, out of 28 analysts covering the stock, get this, 0 have a buy rating.
0? Seriously?
0. 75% are just sitting on hold. Another 25% are actually on sell.
Huh. So where's that skepticism coming from then, if the results were good?
It seems to stem directly from their valuation models. Most of the fair value estimates we saw clustered closer to $25 a share.
$25, okay, and it's trading near, $39 right now?
Exactly, near $39. So the models are flagging it as significantly overvalued.
But if they just crushed estimates, why should we care so much about maybe stale valuation models? And isn't the actual market price action saying that analysts might be wrong this time?
That's the million-dollar question, isn't it?
Must be keeping portfolio managers up at night trying to figure out, do you trust the spreadsheet or the tape?
Precisely. And that momentum we're seeing, it seems driven by this classic sentiment standoff. You've got the bears just incredibly entrenched.
How entrenched? What's the short interest look like?
It's enormous. Over a quarter of the tradable stock, 26.66% is currently shorted.
Wow, 26%.
Yeah, people betting hard against it. And it would take them about 3.4 days of average trading volume just to cover those shorts if they had to.
Okay, so that's not just skepticism. That's, like you said, a perfect setup for massive volatility, potentially a squeeze.
It is. But contrast that, like you pulled from the research, with the bulls in the options market.
Right. The short-term options picture looks bullish.
It does. The put-to-call ratio is sitting at 0.52.
And just remind everyone, a ratio below 1 generally means?
It means more people are buying calls betting on a price increase than buying puts, which bet on a decrease. So it shows a pretty strong short-term bullish lean right now.
Okay, so huge short interest, but bullish options action. What does the chart say? How does the technical picture look?
Well, the chart really reflects this battle.
Yeah.
If you look back, the stock absolutely plummeted, right? From over $40 down to nearly $32 just in late October.
Yeah, that was ugly.
But then it was saved by this massive surge on November 5th. Huge volume on that day, too.
Okay, a big reversal candle.
Exactly. And that price action confirmed a significant bullish reversal. The volume suggests strong accumulation, buying interest coming in.
That sounds promising technically, but hang on, we just established the bears are super heavily entrenched, right? Is one high-volume reversal day really enough to scare off sellers holding 26% of the float? Isn't this maybe just bait for the shorts?
That's the risk, absolutely. But for technical traders, the conviction comes from where the price is now. It's decisively back above both its 50-day and, crucially, its 200-day moving averages.
Ah, okay. Crossing that 200-day line is often seen as pretty significant, isn't it?
It's huge. It often signals a potential shift from a long-term downtrend to maybe a major new accumulation phase. Okay, so let's try and synthesize all this. We've got stellar operational results, but zero analyst confidence. Huge short interest, but bullish options, and a strong technical breakout. Where does our research land on a verdict here?
Well, putting it all together, the verdict from our research is cautiously bullish.
Cautiously bullish.
And it's largely driven by that technical picture, that strong reversal, and frankly, the short squeeze potential. If the price keeps grinding higher, those short sellers, they might be forced to buy back shares just to limit their losses.
Which adds fuel to the fire.
Right.
Creates its own buying pressure.
Exactly. But the cautiously part is key. There are three major risks you absolutely have to watch.
Well, yeah, what are they?
One, that negative macro shock we talked about from the shutdown. If that hits sentiment, risk assets like SEDG could get hammered. Two, the short sellers could just reassert control if this upward momentum falters. They might see weakness and pile back in.
Right. And the third, the company itself. Any cautious forward guidance from SolarEdge in the near future could easily dampen expectations and take the wind out of the sails.
Got it. So for anyone watching this volatile situation, you need those key levels, the battlegrounds. What should people be watching?
Okay, so for the bulls, they really need to break and, importantly, hold above that recent high. That's $41.59.
$41.59. Okay, that's the upside target for now. What about the downside? Where's the line in the sand?
The absolutely critical support level, the one that pretty much invalidates this whole bullish reversal thesis if it breaks, is the 50-day moving average. Right now, that's sitting near $35.98.
$35.98. Okay, so a close below that, and the bullish case gets wobbly.
Very wobbly, yeah. You know, if you step back and look at the big picture here, SolarEdge is kind of like the market's Schrodinger's cat right now.
How so?
Well, it's simultaneously looking like a fundamental value trap based on analyst models and a powerful technical breakout, potentially driven by, forced buying from shorts.
So it's both dead and alive until we open the box.
Pretty much. The next few trading days are really going to open that box and reveal which reality is going to stick. It's a fascinating setup.
Definitely one to watch closely. Okay, great breakdown. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.